All righty. Wow, we already have some early birds joining the webinar. You guys were diligent and waiting to come in. I'm very impressed. Well, it's nice to meet everyone. My name is Luke Robinson, and I am a new business advisor here at Collective. And of course, we have an exciting webinar today, a webinar that surrounds everyone's favorite topic on the planet, taxes. They're riveting, they're amazing, but unfortunately, they're expensive. So we're going to talk about them. We're going to talk about how we can lower them and make that situation a little bit better. But as we kind of wait for people to trickle in here, let's talk about a little housekeeping. And before I do that, I'm really curious what type of businesses you guys are in. You know, it's long story short, you're probably here because you want to figure out how to lower your tax bill for your business. So if you don't mind, in the chat box, tell me what you do. What's your business and what's your industry? Are you a professional sheep shearer? Do you do underwater basket weaving? Tell me what you do. Oh, Adrian owns a swim school. Okay, I wish I did a little bit more of that when I was a kid, and maybe I. We've got a tax prep person. Okay, Janet, occupational therapist for Lisa. I talked to quite a few of those. HR consulting, interior design. I love it. Comedian. Paris is a comedian. Hopefully you can make me laugh. We're going to have a Q&A session at the end, and hopefully you can ask a funny question. I haven't laughed in weeks. A painter. Okay, well, Beth is a painter, and that's interesting. I'm here in Sarasota, Florida. That's where I live, and we're home to the Ringling Art College. So thankfully we have the benefit of all the brilliant art students painting murals all around the city. So I'm just in an artistic wonderland all the time. All right, Felicia, we got an event and film production here. Maybe she can make me famous one day. Okay, well, thank you guys so much for letting me know what kind of industries you're in. And let me just kind of go ahead and jump into the webinar. If there are any sort of feedback or questions you have about this, send us an email at webinars@collective.com. We're happy to hear your feedback and any suggestions you have or questions you have. It's also important to note that a copy of this recording, will be sent to your email within 24 hours. So whatever email that you use to register for the webinar, you'll receive that recording in that email. And also, at the end of this session, we'll have a Q&A session. And so you'll be able to ask me any question under the sun about taxes or anything else you might be interested in. And there are two types of chat boxes to get that done in. One, there is actually a Q&A chat box. So of course, for questions at the end, go ahead and put your questions in the Q&A box. But just for logistical questions, like there's a problem with the sound or anything like that, put that in the chat box. And this just kind of helps us, keep them organized. And with that being said, I think we've got enough people to go ahead and start the webinar. So let's get going. For one, the topic, how to lower your tax bill. And just in general, tips for self-employed individuals, in the context of taxes. What can you do to lower them? What can you do to make them more efficient? And what does all of this stuff mean, essentially? Here's our agenda. One, we'll talk about challenges for being self-employed and for individuals and estimated taxes. As you know, being self-employed by itself is challenging, and we'll talk about why that is. Two, we'll talk about estimated taxes, the basics of it. Estimated taxes are questions. I get questions about estimated taxes all the time. They're a little confusing. It's hard to know when to pay, what to pay. So we'll go through that. Then we'll go through the differences of state and federal taxes. Every single state has a different sort of tax set of tax law. Some don't have income taxes, some have income taxes, and we'll kind of discuss how that works. Then we'll discuss the consequences if you don't pay your taxes, or if you don't make your estimated payments. We'll talk about what could happen. Then we'll talk about S Corp, and we'll talk about how maybe going the S Corp route could possibly lower your estimated taxes and your taxes in general. And then, of course, at the end, we'll do a Q&A session. Okay, well, this is important to note before I go on. Think of this webinar as educational. Don't consider it legal advice. Don't consider it tax advice. The tax code is extremely complicated. So before you go forward with any of this information, it's important to consult with a professional. Talk to a tax advisor, get some guidance before you do anything specific. Okay, well, let's start off with the challenges self-employed people face. One, the biggest challenge, well, maybe not the biggest challenge. I know it's hard to work as a business owner just by itself, but one of the huge challenges are taxes. How much self-employed people pay in taxes? Long story short, it's a lot. And we're dealing with two main groups of taxes here. For one, we're dealing with the income tax. And this is what most people think of when they hear taxes in general. They think of the income tax. And the income tax, it's a federal tax rate, and it's based on brackets. It's marginal tax rates in brackets. So for example, they're between 0 and 37%. And what that means is chunks of your money are charged different tax rates. And we have a progressive taxation in this country. So as you make more money, those separate chunks of money get charged higher tax rates. So, for example, from $1 till $10,000 might be charged a certain tax rate. That might be charged 12%. From $10,000 all the way up to $25,000, that might be charged 15%. From 25,000, et cetera, et cetera. That's how marginal tax breaks work. Some people think that we just have a flat tax rate to where you're just charged a percentage rate on all of your money, but that's not how it works. They work in margins. The other group of taxes are self-employment taxes. And of course, obviously in the name, this is a tax that all self-employed people pay. And I'm getting ready to blow your mind, so get ready. The self-employment tax, which is 15.3%, it's a flat tax rate of 15.3%. Literally what it is Social Security and Medicare taxes. That's what the self-employment tax is. So even when you work for somebody else, as a W-2 employee, for another company, you still pay the self-employment tax in effect because you pay the Social Security and Medicare tax. It's even the same tax rate when you're an employee. It's 15.3%, but the only difference is your employer pays half of it for you. Just by law, your employer pays 7.5% of it, and you pay 7.5% of it. When you're self-employed, though, you are the employer. There's no one else that exists there to cover your tax bill. So you pay both halves. Long story short, that right there is why self-employed individuals pay so much in taxes, because they pay that full 15.3%. And here's a prime example of that. This example is between an employee, someone that works for somebody else, and a self-employed person. And in this scenario, these two people or these two individuals make the same amount of money. It looks like right here, it looks like the example is probably around $100,000. Let's just assume that each of these people make 100 grand apiece. The employee making 100 grand only pays $7,500 in the Social Security Medicare tax, or the self-employment tax, or whatever you want to call it. The self-employed person pays $15,000, double. How your taxes work when you're just a sole proprietorship or an LLC is the following. Here, you've got your revenue, which is another word for gross income or gross revenue. That's the technical term for all the money that you've made in your business. Every dollar is your gross income, gross revenue, whatever you want to call it. Then you have tax deductions that you can write off. And tax deductions are, of course, just another way to say expenses. These are business expenses that you're allowed to deduct from your gross income. Once you deduct them, you get your net income, which of course is just simply just your total money minus your business expenses. That is your net income. That number is either a positive number, which means you have a profit, or it's a negative number, which means you have a loss. And that means that you've spent more than what your business has made. That profit or loss, either one, will be reported on your personal tax return. And that it's reported on and it flows to your personal tax return, and it's reported on there, typically on your Schedule C, of your personal return. So that's how it flows to your returns. And then once it gets there, it's subject to taxes. It's subject to the self-employment tax, the 15.3%, of course. And then it's subject to income taxes, both. So you kind of get hit, unfortunately, by a double whammy. And it's expensive, to say the least. And it's even more unfortunate because when you are running a business, typically you're a little bit busier than a W-2 employee or someone else that's paying less taxes than you. So you kind of get hit on all sides when you own a business. Okay, let's discuss estimated taxes. I get a lot of questions about how estimated taxes work and whatnot. So let's go through them. Who pays estimated taxes? Who's required to pay them? Who they relate to? Long story short, anyone that thinks they could owe, any self-employed person that thinks they could owe $1,000 or more, $1,000 or more in taxes, is typically someone that needs to pay quarterly estimated taxes. So independent contractors, let's just say that you're a freelancer or doing work like that. Typically, you need to pay them. People that own their own businesses, of course, and whatnot. People that file as sole proprietorships, that don't have any LLC set up or anything like that. And LLC owners, people that own an LLC or a share or a part of an LLC. Let's go through the basics of estimated taxes. Taxes must be paid as you make money, as you earn income. And typically, they're either paid to the government in a couple of ways. One is through withholdings. And when I say withholdings, I mean if you're a W-2 employee and you're being paid a paycheck, then there will be withholdings taken from your check by your employer, and your employer will pay them over to the government for you. So that's what it means by withholdings. Or you have estimated tax payments, which is kind of like you handling your own withholdings, you handling your own income and paying it to the government directly. There's no employer there to do it for you. So that's an estimated tax payment. You must make payments if you expect to owe $1,000 or more. We've already discussed that. If you don't pay enough throughout the year, and let's say that you get to the end of the year and you owe a big tax bill because you haven't been paying estimated taxes or have withholdings, then you could pay a penalty potentially. You may be charged a penalty if your tax payments are late, even if you're due a refund when you file your tax return. So even if you technically don't owe any tax, when you file your tax return at the end of the year, you get a refund. If you were late on your estimated taxes, you could technically still be charged a penalty, which I know sounds kind of insane. And they're due quarterly, of course, estimated taxes. April 15th is the first, June 15th, September 15th. And it's important to note that the last estimated tax deposit is due the next year in January 15th. Okay, let's talk about the differences between federal and state and what's going on there. Okay. One of the, I think, biggest challenges, I've been talking a lot of challenges here about being self-employed, take your pick, of course. But one of the biggest challenges is staying compliant. There's so many forms, there's so many sort of compliance issues that you got to keep in mind when you're dealing with the federal and state governments. And one, there's varying estimated tax forms. The federal government has, of course, has estimated taxes that you have to pay quarterly, but some states do as well. Some states don't. Some states don't even have an income tax, so it kind of depends. But that's an area where they'll differ is their estimated tax payments can be quite different. Another way they could differ are due dates. So, the federal government has them due quarterly at a certain time every year. And most states, follow those same rules, but some don't. So it's important to research that and see what's going on with your state there. And then, of course, the state estimated tax payment amounts, how much you're required to pay, each quarter and whatnot. With the IRS, it's pretty simple. Your taxes are split evenly across the year, so it's just 25% each quarter equals up to 100%. But the state might be different. With California, if I'm not mistaken, there's one estimated tax payment to where you don't owe anything. It's $0, so you don't even really necessarily have to make it. In the next one, it's double than what you typically owe. So, long story short, the states can be kind of wonky with that kind of information. And then it's important to get ahead of owing too much and owing penalties too. Any payment that you can make with your estimated tax payment is usually better because it reduces your tax bill, of course. It reduces the chances that you might be charged a penalty. And at the end of the year, you won't have, or it'll be less likely that you'll have a huge tax bill that you've got to come up with the money to take care of. Okay, let's talk about the consequences of not paying estimated taxes. What happens? What happens to you if you don't pay your taxes? Essentially, for one, you owe a lot of money, which can be a stressful situation, and it adds up quick. Believe me, I can't tell you how many business owners I've spoken to where at the end of the year the tax bill just absolutely shocks them, and before they know it, they owe 40 grand in taxes, and it's they've got to come up for it all at once. So that's a situation you do not want to be in. So prepare for that, in my opinion. And the IRS, what could also happen is the IRS or the state may assess underpayment penalties throughout the year. They want to collect tax throughout the year, and if you are not doing that, they might penalize you. Also, it becomes harder to plan throughout the year. If you're not paying your estimated taxes, a lot of your finances and the money that you have in your business is it's a little bit misleading because you're going to owe that money to the government anyway. And a lot of people will take that money and spend it on business operations, spend it on other things besides taxes. And so it's a lot harder to plan. Also, probably one of the most obvious points here is falling behind can lead to compliance issues and emotional stress. That's no joke. When you're already running a business and then, with all the stress that entails, and at the end of the year, you have to find out how to get in a payment plan of $50,000, it's stressful to say the least, and it's not something you want in your life. Okay. What's the difference between, oh, I'm sorry. What's the difference between underpayment penalties and late payment penalties? Underpayment is when you don't pay enough of taxes throughout the year, where your your estimated tax policy is just you're paying them quarterly, but they're just not appropriate. They don't um, cover the whole tax bill for that quarter. They can assess you with underpayment penalties, and they're based on the amount that was underpaid at the time that it was unpaid, essentially. Late payment penalties is something else. So that's just simply when you pay your estimated taxes after the due date, regardless of the amount it is. That's another type of penalty. Okay, now let's get into S Corps. As we've talked about how terrible taxes are and how you have to pay them and how much they are. But now let's start talking about how we can lower them potentially. Like we already said, paying taxes as a solopreneur, as an LLC, or a sole proprietorship, anything like that, you're paying two types of taxes: income tax and the self-employment tax. And they're in addition to, so it can be a pretty hefty tax bill when you're just an LLC or a sole proprietorship. Here's how it works though with an S corp, and things are a little bit different, of course, and they're a little bit more a little bit more beneficial. They could be substantially more beneficial. And let's go through an example here. On the left, this is this represents someone as a sole proprietorship or simply an LLC. This is before they go the S corp route, and their profit is $160,000 right here. You can't pay yourself a wage when you are a sole proprietorship or an LLC. That's not a thing. You know, all the profits pass through to you. All of them, come to you, of course. So that means that all of them are subject to the 15.3% self-employment tax, the full 160 grand. So here, your total self-employment tax is close to $25,000, quite a chunk. Over here on the S corp situation, it works a little bit differently. And what happens with an S corp is technically you become a W-2 employee of your own business, of your own LLC. And you're still the owner, of course, like you still own your business, it still belongs to you and whatnot. But for tax purposes, you become an employee of it as well. And since you're an employee, you will pay yourself a wage. You'll pay yourself a salary, just like you'd make if you work for somebody else, as a W-2 employee. But now with S corps, the self-employment tax, like the 15.3%, is now only subject to your salary with an S corp. So let's go through this example. This S corp is making the same amount of money in total as the sole proprietorship here on the left, $160,000. But here, this owner of this S corp has decided to pay him or herself $60,000. They've determined that $60,000 is a reasonable, applicable wage for them. So that's what they're going to do. And they're going to take the rest out in distributions. Now, only this 60K wage is subject to the self-employment tax, whereas before it was due to the whole 160. So this self-employment tax drops from $24,000 to $9,100, which obviously is quite a substantial difference just in changing your tax election. So, once you reach a certain income level, it can become extremely important to at least consider going this route and to do it as soon as you can. Okay. How does this rope into lowering estimated taxes? How does this work? It reduces the self-employment tax. Only the salary now is subject to the Social Security and Medicare tax. And this is a salary that you can choose. It lowers estimated taxes, of course. Since your tax bill in general is lower, the amount you pay quarterly can now be lower, of course. And then it simplifies compliance. It simplifies actually paying these taxes. Now that you're going to be on a paycheck, you're going to have withholdings that are coming out of this paycheck and are automatically paid over to the government. So it makes it a little bit easier, oddly enough. Oh, okay. Well, here we have a poll question. And it is, of course, would you want to meet with a collective advisor after the webinar to see, if you could save with an S corp? Because not everyone needs to be S corps. This can be a little bit of a complicated situation. So what we do is we offer a free conversation with a tax advisor that'll go through, see if an S corp potentially could be in your best interest, and see if collective could administer it for you. And I'll go ahead and give people some time to answer that poll, and we'll see We'll see if people are interested. Okay, and I already have some really good questions in the Q&A box, so I'm really excited to get to that section. And I promise I'll do my best to answer every single one of them. All right, we will see the poll right now. Okay, well, it's almost 50-50, leaning yes. Um, leaning yes, which of course is great, but there's still some no's. Well, that's okay. If you think that you're ready to go and S Corp makes sense, we can make that happen. But also the people that would want to uh, have a conversation, we offer that too. Okay. Well, Collective works with solopreneurs making over $60,000 in profit, and also with minimal W-2 income. If you got a really high uh, W-2 job, a really high paying W-2 job, you might not want to go forward with the S Corp quite yet. But we give, in terms of a self-employed person, we give a $60,000 profit suggestion. And I actually saw this question in the Q&A box. That's also the suggestion that we give to at least have that amount in income before you go S Corp. That's kind of the threshold that we suggest, before you go the S Corp route. So with that being said, we work with sole proprietorships, people that don't have anything set up yet, people that don't have their S Corp or LLC set up yet. We work with single member LLCs or PLLCs, people that already have their business structure set up, and focus on the single member. Right now, we can't assist partnerships or anything like that. So it would need to be single member. And then also, if you're already filing as an S Corp, then we'll handle that too. And of course, if you're making $60,000 or more in profit. Okay. Our main statement here is we'll handle your paperwork and you can focus on your passion. We'll handle your back office so you can grow your business. And essentially, when it comes to your business, we do the whole shebang. We'll set up your S Corp, of course. We will handle your monthly bookkeeping month to month. We'll calculate your quarterly tax deposits. Those are still a thing with an S Corp. We will handle your business and personal tax returns. The personal tax return being an add-on, the business return included in your collective membership. And then, of course, we'll handle your payroll because you'll be on a paycheck with this new tax structure, and that will need to be administered. And then, of course, we'll also give you some guidance on salary amount, because that's another that's another sort of compliance issue with the IRS, or a sort of area of confusion with an S Corp, is how much do I pay myself? How much do I make this W-2 salary without getting thrown in jail? You know? And of course, you'll receive ongoing support from licensed professionals. You can set up meetings with your advisor here at Collective ongoing, and you'll get that support year round. Here's how much we cost. You've got two ways to pay. If you go the month to month route, it's $349 per month. We'll contract. If you pay in full just for 12 months at a time, we'll give you 15% off. So that averages out to around $35.60 per year. Then there's a one-time onboarding fee of $199. And that covers, setting up the S Corp, cleaning up doing some back book cleaning, bookkeeping cleaning, and getting you set up. That includes all your tools, all your software costs, your payroll tools, invoicing, the bookkeeping, the whole shebang. And excitingly enough, Collective is tax deductible. Collective will be a business expense for your business. So, not only will you save money with the S Corp, but you'll save money on writing off this expense as well. Okay. And since you were a gracious attendee of this webinar, there's some discounts that are involved. And if you bring this code with you while you schedule a call, April on us, you'll get your first month free. And it's an amazing deal, obviously. Hallelujah for April. And of course, if you schedule this QR code, you can go right to the place where you can schedule a call with an advisor to kind of see, what you should do next. And quite frankly, there are a lot of people on this webinar that are making great money, that are running successful businesses, have thought about the S Corp for a while, just haven't really done it. It is important to do it as soon as possible. I can't tell you how many people I've spoken to that leave thousands of dollars a year on the table in taxes simply because they have not gone forward with the S Corp yet. The longer you wait, it'll be another year to where you have a big tax bill to an IRS. If you're going to go the S Corp route, do it as soon as you can. And I would encourage you, even if you're not really sure if you want to go this route, to at least schedule a call, get some guidance. And I would do that literally today if you could. That's how important it is with the amount of money you're making and how much an S Corp could save you. And let's say that, collective isn't the best fit for you, or an S Corp is not something that you need to pursue at this time. We'll tell you that. Your advisor will be honest with you. They'll guide you, they'll point you in the right direction, they'll guide you honestly. And if you're not in a situation where you need collective services, of course, we'll tell you that. We'll give you some great referrals. Like I said, we'll point you in the right direction. But it's very important to at least check if you should go the S Corp route. It could literally mean thousands of dollars. With that being said, we've technically reached the end of the webinar, which means we can go into the Q&A section. And I'm going to answer as many questions as I possibly can. And it looks like we already have a good amount to get started on. Okay, the first one is a really good one. If a business is reporting losses for a few years, does it raise a red flag with the IRS? It could. It certainly could. It doesn't necessarily, because sometimes businesses, do have losses for a few years, especially when they're first getting started up. But something the IRS would question is if you have losses year per year, the IRS might assume or at least suspect that your business is really a hobby, that you set up this business when it's really your hobby, so you can write off expenses and reduce your tax bill, maybe on other areas of income or something like that. So they'll say, well, why aren't you making a profit? Is it would it happen to be because you have no intention of making a profit because this business is just simply essentially a hobby in disguise? So it could. What I'm saying is it could raise a red flag. They could deem it to be a hobby and they could disallow all your business expenses and charge you penalties and tax. So it's something to keep in mind. Is the penalty calculated on the total tax amount for the year or only on the amount over and above the estimated tax paid throughout the year? It's typically charged on the tax that you didn't pay. How much more do you owe in taxes? Is typically what that penalty is charged. Okay. I have an LLC and I'm presently fundraising for my Women's Heart Health Initiative. How should I handle the contributions of personal account? How should I handle the contributions a personal account in the fundraiser name? Right now, it's in my new business account. Hmm. I'm having a little trouble deciphering the question. How should I handle the contributions made to my? If you're saying how should you handle the contributions you've made to this business, then it should probably be separate. Like if you have an LLC and a profit motive, but you're also fundraising for a woman's heart health initiative, that sounds like more of a nonprofit endeavor. And I would keep that completely separate from your LLC. Like I wouldn't do it in your business account and whatnot. And if you have put money into your business account, oh, I see. So the fundraising proceeds were deposited into your business account. What Probably what I would do is just leave that off as income on your profit and loss statement when you put all your stuff together. Just assume that it didn't even go into your business account. And you need to report that income somewhere else, like a nonprofit or something like that. But that's honestly that's kind of a complicated situation. So I'd probably talk to a tax attorney or a CPA to get some guidance on that. How do the taxing authorities know if you underpaid estimates if you're paid in full at the end of the year? Well, because they can go back and see how much you owed at that particular time and how much you paid. Like, they can see the history of that. So even if you're paid in full at the end of the year, they can go back and see if you did it late or if there were underpayment penalties in each quarter. And just because you're paid in full at the end of the year, that can just mean that you wrote a big check on, December 31st to just handle all the rest of your taxes. But unfortunately, you could still get penalized. What happens if an owner pays himself through payroll but never actually finished the S Corp paperwork? Well, it's just unnecessary and it might cause just a little bit of problems. Like it's just paying yourself in payroll is simply just you putting yourself on W-2 and paying self-employment taxes on your salary, but it shouldn't there shouldn't be anything serious happen, but it's just extra work that doesn't need to be done. Is there a trust that can be established that basically owns the S Corp? Yes, yes, there is, but I would talk to a tax attorney about that. How much net income should I be making before considering S Corp? $60,000 a year. Collective gives a suggestion of $60,000 in net income, before you go the S Corp route, or to at least expect to have at least that amount in net income before you go the S Corp route. And the reason we say that is because very generally, when someone is making around $60,000 per year and they go the S Corp route, they're saving somewhere between $5,000 and $6,000 in the self-employment tax. Again, that's very general. That's not set in stone, but that's generally where it ends up. That $5,000 to $6,000 covers collective's fee and then some. You are saving more money than what you're paying collective at that income level. Now, as you drop below that 60 grand mark, let's say 40 grand. Let's say that your net income is 40 grand. You'll still save money with an S Corp. It just might be the exact same amount as what you're paying collective. So you don't save money overall because all of your savings are going to pay collective to administer this S Corp. With that being said, though, there are still people that will join collective in between that 40 and $60,000 mark because they're getting all their stuff handled. You're getting your bookkeeping handled, your payroll, the whole shebang, and essentially for free because the amount of money you're saving with the S Corp is exactly the amount of money that you're paying collective. Is there a minimum amount of business revenue that must be met before an S Corp can be established? 60 grand. Or if minimal, small side income in addition to Social Security benefits, do the overhead cost of managing the S Corp negate the potential tax benefits? Yes. In that situation, if you have Social Security, if you're making Social Security and you just have some minimal side income, I would not go the S Corp route. It's not time yet. What about the distribute? Okay. How are the distributions taxed? It's a really good question. The distributions in an S Corp, like something outside of your salary, they're no longer subject to the self-employment tax any longer that we discussed, but they're still subject to the income tax. You still pay the amount that you pay in income tax won't really change. It won't change much between sole proprietorship, LLC, S Corp. That pretty much stays the same. It's the self-employment tax that you're saving money on. As an LLC, I'm using my own money to fund my business. Can I do a draw to get my money back? Of course you can. Absolutely. Let's say that you've deposited um, money into an LLC just for personal contributions or whatnot, you can absolutely give a drawback to yourself in your personal account if you don't need that capital anymore. And essentially, what you would want to do is just mark that as kind of like a return of capital, or something like that. But again, that those sorts of issues right there is a really good benefit of having a collective membership. Is with those sorts of issues, you can hop on a call with your advisor, get some guidance, and we'll help you through it. How does the owner distribution part work as an S corp? Well, here's how I like to explain it. With an S corp, you essentially have two buckets that your earnings go through, or you can think of your earnings, kind of in two buckets. In one bucket, you have your W-2 salary, whatever amount that is, and that will flow from your business bank account into your personal bank account, just like a check would. So weekly, monthly, bi-weekly, whatever's most convenient for you, that's how we'll set up the payroll processor and pay you your paycheck. Your second bucket of earnings are your distributions. And how you take a distribution is you just simply transfer money from your business bank account to your personal bank account. You're done. You've taken a distribution, and you can do that throughout the year and anytime you want. Um, Now there are implications on that, and you have to be careful with that, because if you don't do it correctly, if and I'm getting a little bit too into it though, but let's say that you distribute money above your basis in the business, then that could be subject to capital gains tax. That's rare. That doesn't need to happen, and it only happens in certain situations. But your collective advisor can help you talk through that and prevent that from happening. If you start as an LLC because you do not believe you will make much money, when should you change it over to an S corp? $60,000 net income. Once you get to a point to where you'll start consistently making at least $60,000 net income. It's even better if you're making more money, like $100,000, $150,000. But if you're at that level, then that's when we would typically suggest an S corp. If you take owner distributions, how much tax do you pay? Well, you don't pay any more tax just by simply taking owner's distributions. You are subject to the distributions are subject to the income tax, regardless if you actually take them or not. And taking a distribution is simply just transferring money to yourself from your business. It's almost like taking an owner's draw. But even if you don't take an owner's draw, let's say at the end of the year there's $100,000 sitting in your business bank account, because for whatever reason you just haven't taken a distribution. That money is still subject to the income tax, regardless, even if it just sits in your account. Um, so keep that in mind. Can you pay your kids for helping you in your business accounting and MGM? Yes, technically you can. Technically, there's nothing wrong with paying your children if they're actually doing work for the business. You can't just set it up as a scheme to pay your kids some money, um, to save in taxes and for financial benefit when they're just playing on their Game Boy and catching Pokemon. But I mean, you could do that, but it would be improper, and I wouldn't recommend it. And you could get audited, by the IRS pretty easily. But if you do it properly, sure, there's nothing wrong with paying your kids, but you must do it properly. It's complicated. There's a lot of documentation you need. There's a lot of substantiation you need. So just be very cautious with it if you do it. If you filed as an LLC in 2024, can you go back and amend as an S corp? It's essentially too late. Now, technically, it's possible, but it's a lot of work. And a lot of times, a tax attorney needs to get involved and do a bunch of these elaborate things. And usually the cost for something like that could easily be like $10,000. And, to pay an attorney or someone to do that. And usually that eats up all the savings that you get with an S corp in that same tax year. As a K1 employee, can I become an S corp? I don't really know. There's no such thing as a K1 employee. Now, probably what you're getting is you're receiving a K1, which means that you have a business ownership in a business. So, like for example, if you already have an S corp, or if you have an ownership in a partnership or something like that, your share of the income in the business is reported on your K1, and then that K1 is sent to you. So if you're getting a K1, you're either already an S corp or you're involved in some sort of business. Is essentially what that means. But let's say that you're getting the K1 because you have a partnership, and a partnership is just two or more people on an LLC. That partnership can be an S corp, but the K1 itself, that doesn't really. I wouldn't be able to tell you that. Will you be able to send over a copy of this recorded webinar? Absolutely. Whatever email that you use to register for the webinar, within 24 hours, we'll send you a recorded a video of it. What about a retired teacher getting a pension and doing well in business? You very well could need an S corp. Even though that you're retired and getting a pension doesn't. If you're doing well in business, then an S corp could potentially still be beneficial. Sure. What does it mean to be an LLC or a PLLC who files as an S corp? That is a great question. So there's a lot of people that have a misrepresentation about what an S corp actually is. An S corp, well, and back up. One of the reasons that is because unfortunately, the IRS is terrible at terminology. They're awful at it. No, they're not wordsmiths, to say the least. So when you hear the term S corp, anyone rational would assume, oh, that means a business entity by itself. That means a corporation. Of course you'd think that, but it's wrong. An S corp is not a business entity. It's a tax election. It's a way to ask the government to tax your business entity in a certain way. There is no such thing as an S corp by itself. So you either have to be an LLC, a PLLC, a partnership, or a corporation. You have to set up a corporation first before you can make an S corp election. So you have to have one of those things first before you can even go the S corp route. Here at Collective, typically, we will suggest starting an LLC first or a PLLC first and making an S corp election, because starting a corporation is usually needlessly complicated. Most people don't need a corporation as their base entity with the S corp, so we suggest an LLC or a PLLC. You mentioned payroll includes handling payroll. Does that include if you eventually decide to hire an employee or freelancer? Would you help with payroll for them as well? Absolutely. If you get to a point where you hire a W-2, if you hire a 1099 freelancer or whatnot, you can run their payroll on our payroll processor, and we'll file the 1099, we'll file the W-2, we'll handle all the tax paperwork. So that certainly is an option. Is Collective only for people who want to be an S corp, or is the price different for those staying as an LLC for now? As of now, Collective is only for people that want to be an S corp. Now, we're growing all the time, and there very well might be a membership option here in the future, maybe here in the near future, that only includes an LLC, for people that don't need to quite go S corps yet and whatnot. But we're not quite there yet. Just S corps for now. Is it too late to elect an S corp for 2025? Well, no, it's not. But technically, the deadline to do it timely this year was March 17th. So technically, it will be a late S corp election. So what we're going to have to do is we're going to have to make a reasonable cause argument to the IRS as to why it's late. And those are typically accepted, thankfully. But it's important to do it as close to the deadline as possible, as soon as humanly possible. The longer you wait throughout the year, it becomes significantly more likely for the IRS to reject the S Corp election. It's a lot more error prone because we have to go back and fix everything. If you're going to go the S Corp route, I would do it as soon as you possibly can. Is there anything around liability with S Corps? Not really. The S Corp has nothing to do um, with liability protection or anything like that, not a thing in the world. What gives you the liability protection is your LLC or your corporation or whatever business entity you have underlying it. But the S Corp election doesn't sort of include any additional liability enhancements. No, liability protection enhancements or anything like that. Do you work with two-member LLCs? Unfortunately, not. Those are partnerships, and those are a little bit more complicated when you go the S Corp route with a partnership. So right now, we only work with single-member LLCs. I have an LLC and can switch it to an S Corp. What are the downsides of an S Corp, if any? That's a good question. I mean, well, the upside, of course, is that you save money. An S Corp could save you thousands of dollars. So that's the upside. But in order to save that money, there are additional administrative steps you got to take when you go the S Corp route. Um, and so, for example, you got to run payroll when you're an S Corp. You don't have to do that when you're just an LLC or a sole proprietorship. You don't need to do that when you're an LLC or a sole proprietorship. You have to set up the S Corp. You have to file the appropriate paperwork, everything like that. Now, in your accounting, you now have to track a balance sheet. Those are required for S Corps, and those can get complicated. And at the end of the year, of course, you have to file an S Corp tax return. You now have a separate business return that, sort of comes into existence when you go the S Corp route. You didn't have one of those before S Corp. So typically, you only want to go S Corp when it's financially beneficial. Can you please show the page with prices for your services? I can do that. Let me go back. Here we go. I'll just I'll leave it on that page. Beck, thank you for that. Oh, Stefano, it's a really good question. For the sake of clarity, $60,000 in profit or $60,000 in revenue? $60,000 in profit, in net profit. So the $60,000 is after you've written off your expenses, done your deductions. That's what I'm talking about when I say $60,000, not your total income, but how much you have left over. We have two other employees. Does your fee include their payroll tax and W-2? The if you have if you have employees, like W-2 employees, I believe it will cost $15 per employee to run their payroll. And essentially that's just us passing on, like, the fixed cost of running the payroll, but it's a $15 charge, for each employee that you have. Only if you pay them. Why can't you provide this service for partnerships under an S Corp? Because it's more complicated, unfortunately. And right now, collective charge is one price, a pretty low price, if I do say so myself. Our workflows are extremely efficient. And that's because, we're a very niche company. We focus on single member LLCs and, really building the process for them to be as efficient and as great as possible. I think eventually we'll, get into partnerships and whatnot. But as of now, just single member LLCs. Is collective a tax deduction? Yes, it is. It's a business expense. So that's another way that it'll save you on taxes. Oh, here's a good question. Are you able to use the distribution generally for anything throughout your day to day? Or is it to be kept within the company? It does not have to be kept within the company. Absolutely not. You can take a distribution, you can transfer money to yourself from your business whenever you want to. And what I tell my clients is there's not a tax benefit and just keeping money sitting in the business. Taking a distribution doesn't trigger any additional income taxes or anything like that. So since that's the case, I tell my clients to just take a distribution as soon as possible. Whenever you need money, take a distribution, and it's totally fine. Oh, here's another excellent question. If you start as an LLC S Corp today, can you count the full year as an S Corp filing? We can only count the full year as an S Corp filing if you've had an LLC in existence for the entirety of this year. So let's say that you came into 2025 with an LLC already set up. Then yes, then we'll be able to backdate your S Corp election to January 1st of 2025, but only if you already have an LLC set up. If you still need that LLC set up, then your S Corp will start right now. It'll start the moment that we set up the LLC. If you're listening to this and you're a sole proprietorship, you don't have an LLC yet, I would encourage you to schedule a call with a business advisor today, right this moment. And the reason that I say that is because if you're making good money, the longer you wait, the more thousands of dollars are just going into the pocket of Uncle Sam. And my career, I spend all day long, and I'll go back to the QR code here where you can schedule a call. My career is me speaking to business owners all day long, hearing about their dreams, their aspirations, how much money they're making, where they want to go. I'm very inspired by business owners. I think someone has guts when they go off on their own, make it work, and they're making really good money with their own operation. I am very passionate about you saving as much money as you possibly can. If you currently do not have an LLC set up, reach out to us, schedule a call. We'll get it set up as soon as possible, and we'll start saving you money. What are the other benefits of being an S Corp besides the tax reduction? Not much. If an S Corp is not going to save you money, there aren't any additional benefits. The main benefit is that S Corp reduces the self-employment tax. If it doesn't reduce it enough to where the cost to administer it are worth it, then I wouldn't go forward with an S Corp. It's not quite time yet. What is what is a reasonable salary for an insurance agent? I have absolutely no idea. Like, we'd have to, look more deeper at your situation. Like, we'd have to see what's going on. But if you came on board with Collective, we would give you a salary recommendation that had to do with your situation. Certainly. Are there any other deductions that you can take through an S Corp? Not really. You can take all the deductions that you normally can, with an LLC or a sole proprietorship or something like that. But there aren't any sort of additional deductions that come into play when you go the S Corp route. Is there a limit on the distribution a person can take into their personal account? Nope, there's no limit. You can do $1 million distribution. You can do, doesn't matter. There's no limit. Are the distributions taxed as dividend income? No, they're taxed as regular income. So they're just taxed the normal income tax rates. But what they're not taxed any longer are the self-employment tax rates, the 15.3%. But no, they're not necessarily taxed as dividends. Is it easy to switch from an LLC to an S Corp in the middle of the year? I would call it easy. I mean, frankly, the longer you wait throughout the year, the harder it becomes. So if you're going to do it, I do it soon. How much money should you be making annually as a 1099 freelancer in order to benefit from setting up an S Corp? $60,000 a year, net income. After you deduct your expenses or whatnot, 60 grand. What is the best way to determine what your salary should be? That's a good question. Determining your salary yourself is a little risky. because the salary is pretty complicated. And there's a lot of court cases and history and whatnot that kind of goes through into how to set up a reasonable salary. So that's something that we do here at Collective. We have our own method that takes into consideration several things. There's not really an objective sort of method to do it. It's usually a good idea to get advice from a tax professional to help you. Do you have a list of items that can be deducted via the business or examples of deductions? Well, really, a business expense or a business deduction is anything that's spent in that's ordinary and necessary in your course of business. If it's ordinary and necessary, if you can make that argument quite directly, then typically it's a business expense. In the scenario you shared, what happens with the 100K? Are there no taxes paid on that money? You're referring to the distributions. There's still income tax that are charged on those distributions, just no longer the self-employment tax. So you're still taxed on it, just not as much as when you were a sole proprietorship or an LLC. You handle unemployment insurance and taxes. Yes, that will be handled, through your payroll situation. That's how those are taken care of. Oh, here's a great question. Excellent question, Daniel. Does the employer's cost for the payroll tax of 7.5% count as an expense of the S Corp? Yes. Yes, it does. That's brilliant. But yes, so in your 15.3% that's being charged on your payroll, on your salary, the S Corp pays half of it, and then you pay half of it as an employee. The part that the S Corp pays is a deductible business expense. So that's just another way to deduct that on your income taxes and whatnot. It saves you more money. I'm in California as a marriage family therapist. We are not we are not allowed to be in private practice as an LLC, only an S Corp. What should I do to move towards an S Corp? Well, what they're saying is they want you to set up a corporation. So like, there is no S Corp by itself. So if they say if they won't pay an LLC, but they still say that you should be an S Corp, then you should probably set up a corporation first and then make an S Corp election on that corporation. Maybe. Can taxes be claimed as a deduction in expenses? No, taxes are not a deductible business expense. Taxes are charged after you already write off your expenses. Oh, here's an excellent question. Okay. By lowering the self-employment tax as an S Corp, are there negative consequences to future payouts, benefits for Social Security and Medicare care, Social Security? Yes. But hear me out though. That doesn't mean that you shouldn't do an S Corp. But yes, I mean, theoretically speaking, if you pay less Social Security tax, then yeah, your Social Security might be less at retirement age. But here's the thing, in terms of a retirement deal, and I know this might be a little controversial, but it's true. Financially speaking, in terms of retirement, Social Security is not the best retirement avenue. In terms of all the places that you could put your money for retirement, the Social Security system is by far the worst. What the government does is when you pay Social Security taxes, they take that money and they invest it in treasury bills, which gets you like maybe 2% a year. Like treasury bills barely keep up with inflation in terms of how it grows. So if you're concerned with retirement and how much money you'll have in retirement, take that Social Security tax that you're saving and put it into the market. Put it into a really safe, speak to a financial advisor and put it into a really safe ETF fund or some sort of safe investment in the private market. And chances are you will make significantly more money for retirement in the private market system than it will be in the Social Security system. Again, I just want to be clear that that is not my opinion. That the things in the private market grow a lot faster than treasury bills do. So do with that what you will. Are there retirement vehicles to be used for S corps? Typically not. No. Can you take a distribution out and return it back if needed to say to spend on business expenses? Sure. You can make a personal contribution to your business whenever you want to cover expenses. You can do that. So if you're an S corp and want to withdraw all of your profit from your business, should you withdraw it as an employee to get advantage of the tax break? No. So the the idea behind it, so if we go back a little bit, you're only charged the self-employment tax on your salary amount with an S corp. So theoretically, or not theoretically, but it's better tax wise to have your salary as low as possible because you pay less in the self-employment tax. So really, it's beneficial to have most of it taken out as distributions as opposed to employees or paycheck. But what the government says about the salary is that it must be reasonable. So, people will ask me all the time, well, if I'm only subject to the self-employment tax on my salary, then, why not just pay myself $1 in salary? You know, why not pull a Warren Buffett and just, reach in my back pocket and say, hey, here's my salary, it's $1. And my response is because you probably get audited. The IRS would probably not be too happy about that. They would say that, they'd point at that and say that's an unreasonable salary. You're not paying yourself enough in W-2 employment, and they could penalize you. Is the S Corp the only entity we can get a paycheck as business owners? No, I mean, it's the main one, but the other one is a C Corp. Let's say that you're a 100% share owner in a C Corp. You could still be on a W-2 with that C Corp, sure, but that's typically what you want. Most people don't need to be C Corps. Will this presentation be repeated? Yes, it will. And whatever email that you use to schedule this webinar, we'll send you a recording of it within 24 hours. Do you help your clients with establishing a retirement plan? We'll help you with that, certainly. And with us, what we'll do is there's several options for retirement plans, S corps, and whatnot. There's solo 401ks, SEP IRAs. They each have different benefits and drawbacks and whatnot. We'll help you choose one. We'll talk about the implications and whatnot, and we'll handle all the tax implications and accounting and bookkeeping that have to do with these self-employed retirement accounts. I'm a sole proprietorship. What do I need to do to become an LLC? Martha, I would schedule a call, truly. I would schedule a call with Collective right now. See what's available, scan that QR code. You can go to collective.com and schedule a meeting. But we'll set up an LLC for you. And if you're currently a sole proprietorship and you'd like to go S Corp, this needs to happen as soon as possible. So a person would not need to put money into the Social Security tax. Well, you're putting a lot less into it when you're an S Corp. Oh, here's a good question. How long has Collective been in business? We've been in business since 2018. And our story is the company was founded by immigrants. And when they got to the United States, they realized how complicated the tax situation was. They were industrious and entrepreneurial and starting businesses and, trying to create some, really good value. But they noticed that the US tax code was extremely complicated and they didn't know what to do next and whatnot. Um, and then Collective came into being. Like, we're a one-stop shop, all-in-one financial solution for your back office and to administer your S Corp. Okay. Well, that's all the questions from the Q&A box. Let me see. I think there's a couple more questions in the chat box. Um, and let me go back, and 'cause this is a really good question. Can health insurance be deducted? Yes. And that's something else that we'll help you with too. With an S Corp, in certain instances, of course, you can deduct your health insurance premiums. That's a business expense. And we'll help you do that. Ooh, okay, Lauren's a good question. If I wanted to convert my LLC to an S Corp for the year 2026, when would the best, when would, excuse me, goodness, when would be the best time to get that initiated? Lauren, I'd probably come back to us sometime at the beginning of, actually, I'd probably come to us probably sometime in the middle of November. Come back at that time and have a conversation with us, and we'll get it started for 2026. Okay. Oh, David, here's a really good question. What is the max AGI before Social Security is taxed? I'm not. I'm sorry about that. I'm not sure. I'm not sure what the threshold is for the Social Security benefits. I will say though, there's actually an income cap to the Social Security tax in general of the 15.3%. And for 2020, I'm not really sure what it is for 2025, but for 2024, it was around $168,000. To where once you make that amount of money, you don't pay the Social Security tax anymore anyway on any dollar, above that amount. So there's a cap technically on the Social Security tax. There's no cap though on the Medicare tax. That kind of goes on forever. But there is a cap on the Social Security tax. Okay. Well, that's all the questions. We've got through it, everyone, and we learned so many useful things about taxes. And thank you so much for joining this webinar. I enjoy it like I do every time I do this. Your questions are so intelligent. I'm so impressed. And please, like I said, if you think an S corp might be in your best interest, if you think, oh, Charlene, thank you so much. So the Social Security wage base for this year is $176,000. 100. Thank you, Charlene. But like I was saying, if you need an S corp, schedule a call with us. We will go through your situation. We'll see if that's the case. Like we'll be honest if you even do need to be an S corp, and we'll go from there. But like I said, thank you very much, and I hope to speak to all of you sometime again soon.